In 2021, the financing was great, but the purchase prices were too high, were not attractive. And then in 2022, the purchase prices are much more attractive, but the financing is not. And so you date the loan, but you marry the property. So the loan's only temporary. And so I would much rather be buying in an environment where the purchase prices are more attractive and the financing is not as attractive. So I'm seeing a lot better values out there in the market for sure. And I've seen some price declines already.
Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team I've created called Vox Valens Media is now available to produce shows for you as well. We can do as little or much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing more valuable tasks in your business. Let me know if you're interested by emailing me directly at whitney@lifebridgecapital.com.
This is your daily real estate syndication show. I'm your host, Sam Rust. Joining us today is John Brickson, who's based out of Dallas, Texas, and is the founder and managing principal of McKinney Realty Capital, a commercial mortgage brokerage that primarily focuses on financing value-add multifamily properties, so right up our alley. In 2022, the firm closed over $300 million across 30 loans so far. In addition to his work on the brokerage side, John invests in multifamily and industrial properties, both as a limited principal and a key principal. So John, welcome to the show. Thanks for joining us today.
Thanks, Sam. Glad to be back on the show.
Yeah, definitely. John and I have known each other for a number of years, connected at various conferences and various soirees that happen across the space. And we were just talking before the show got going that this is a very interesting time in the financing world. You know, in the 5 years or so that I've been in syndication and multifamily, it seems like equity is the constant focus as part of the overall capital stack, and financing, while not an afterthought, was certainly something that was relatively stable. Not so much in 2022. John, I'd be curious for your thoughts on where we sit. You know, we're at the end of the third quarter here today of 2022. It's been a ton of volatility. The 10-year treasury has had some pretty significant swings up and down and down and up. And I'd love just your high level thoughts on where things stand in the debt market today.
Sure. And I'll say first to start off that it's September 15th, 2022, and things are changing like every week. And so I'm sure this podcast will come out in 2 or 3 weeks. And so things might be completely different. But where we sit today, 2021 was the year of the floating rate loan, the year of the bridge loan. All of those floating rate loans and bridge loans are priced based on SOFR, or CME term SOFR, which is a short-term 30-day index. And, 2021 SOFR was close to zero for most of that period of time. And today, and SOFR really is tracked closely with the federal funds rate. So whenever the Fed increases the target Fed funds rate, SOFR will move in lockstep with that. And so, today, SOFR sits at around 2.25%. And the next Fed meeting is September, I want to say it's 22nd or 23rd. I could be off there, but it's in the next 2 weeks. And, the Fed, what they're really looking at is inflation and where's inflation, coming in. And Jerome Powell has made it very clear that they're determined to fight inflation, as much as possible. And, my read on that is that they're going to continue hiking until we start seeing some meaningful declines in inflation. And so this last month, it just came out that the print came out this week and it came in at 8.3%. I think some people were, a lot of economists were hoping that it would come in or expecting it to come in closer to 8%. So it declined, but it came in higher than usual. So my prediction will be that the Fed will hike 75 basis points on September 23rd or whenever that next Fed meeting is. And then term or SOFR will be at 3% by the end of this month. So what does that mean for financing? What does that mean for bridge loans? What does that mean floating rate versus fixed rate loans? Well, floating rate loans, the rates have increased quite a bit. So the floating rate loans, it's SOFR plus the spread. And the spread is really the profit for the lender. And so SOFR, has increased from 0 to 3%. And so there's been just a 3% increase from that. And then spreads have increased from, we were low 300s in 2021, low to mid 300s. And now we're closer to 400 to 450 over SOFR. And so really what we've seen from the floating rate loans, those interest rates have increased from, 3.25, 3.75% up to today, they're 7 to 7.5%. Because they're floating, they could increase whenever the Fed goes and hikes rates. And then obviously with the floating rate loans, a lot of these lenders will require borrowers to buy what are called SOFR caps, which basically is an insurance policy or a hedge that will limit how much SOFR can increase. And then that way mitigate or protect you from potential increases in interest rate during the hold period. And so the cost of that insurance has increased significantly. So what's really happened is the bridge loans have become less attractive on financing acquisitions. And then the flip side is the fixed rate. And with the fixed rate loans, those are primarily Fannie Mae and Freddie Mac. Unfortunately, there's really not many non-recourse bridge lenders that do fixed rate loans. So there's not really fixed rate bridge loans out there. I'll come back to fixed rate for non-Fannie or non-Freddie. But Fannie and Freddie, those loans are really driven by your debt service coverage. So Fannie and Freddie will go up to 80%, but they require that the property can cover the annual principal of interest at least 1.25 times. And because cap rates haven't moved quite as quickly as interest rates have increased. The 10-year treasury today is about 3.45%. 60 days ago, it was about 2.8%. 2.7%. So, the 10-year treasury is up about 75 basis points over the last 60 days. And so what that means for Fannie Mae and Freddie Mac loans is that we can only cover at a 1.25 times debt service coverage on most acquisitions at, 50, 55%, 60% LTV. And so Fannie and Freddie are still active, but you just can't get as high on proceeds, as high on leverage as you can get, still with bridge lenders or with other types of lenders. Now, Fannie and Freddie aren't the only types of lenders that are doing fixed rate loans. What we've been doing a lot of more recently, I'd say over the last 60 days, and especially in kind of that small balance space, 10 million and below, 15 million and below, is we've been working with a lot of banks and credit unions, because banks and credit unions are oftentimes able, not all, and every bank lender is different. Some are okay doing fixed rate. Some will not do fixed rate. Some will do fixed rate only for 2 or 3 years. We've been doing a ton of loans with local banks, because the local banks, they're not DSCR constrained at a 1.25 times debt service coverage, and they can do 3 to 5 years fixed. So more recently, especially if it's $10 million and below, we've been directing our clients to go into financing an acquisition with a bank loan. And a lot of times, they are recourse, but you can get 75% of the cost, a 5.25% interest rate fixed, 1 year bio, 25-year AM thereafter. And it is recourse, but a lot of borrowers, they look at that and they compare it with the bridge option that we bring to the table, and they might see that the bank loan it's fixed. There's no SOFR cap requirement. Closing costs are much lower, and my interest rate is 200 basis points inside of the bridge lender. So they're willing to make that trade-off to sign recourse. But I guess I'll wrap all this up with saying, Sam, that in 2021, and I've been telling a lot of borrowers this, in 2021, the financing was great, but the purchase prices were too high and were not attractive. And then in 2022, the purchase prices are much more attractive, but the financing is not. And so you date a loan, but you marry the property. So the loan's only temporary. And so I would much rather be buying in an environment where the purchase prices are more attractive and the financing is not as attractive. So I'm seeing a lot better values out there in the market for sure. And I've seen some price declines already.
Yeah, we've certainly seen that across our markets as well, that the ask is coming down to what I would call more realistic levels. But even so, it does seem like there's a big spread between the bid and the ask on properties that are for sale. You mentioned that cap rates aren't tracking as closely with interest rates. Do you anticipate that to continue? And why is there a gap? Why are cap rates slower to respond, in your opinion?
So, I think a lot of it really comes down to how motivated is the seller, and are they ready to sell? Or are they willing to sit out for another year, 2 years, 3 years, or however long it takes for the market to recover? So I've seen certain situations where people take their property out to market and the listing broker gave them a broker opinion of value at a certain price, and then offers come in and, the offers are 10, 15% below the asking price. And, that seller, they might have a long-term fixed rate loan and they're getting good rent growth. They might just say, I'll just sit and wait and just continue to cash for the property. I've seen other cases where there's people who they might have bought the property 2 or 3 years ago, and they financed the acquisition with a loan that has a lower prepayment penalty, whether it was a bridge loan or it's a bank loan or it's an agency loan, step down prepay, and they get an offer that comes in. And a lot of times, especially if they're a syndicator, they can say, okay, for my investors and, doing kind of the best I can for my investors, I can take this offer today. And, maybe the broker's opinion of value, if I would have gotten that price, this would be a grand slam. But I'll take this offer today, and instead of getting a grand slam, I'll get it a home run. And it's still a really solid return for my investors. And I can wait 12 more months and maybe the market will recover. But, my loan might be maturing in 12 months, or I have less term left in my loan. And, maybe pricing isn't as strong. Maybe, the market continues to decline. And so a lot of those owners are willing to accept lower prices. And then I'm seeing cases where it's a long-term family ownership. They've had the property for 20 years and, they're still seeing this pricing as, being a great return over the term. And they've already had multiples returned on their initial investment because they've had it for so long. And there's ready to move on, so they'll sell. So I've seen properties that, I'm working on a 3-property portfolio right now that's in DFW. And it went under contract at 47 million, right as rates started increasing. And then it fell out of contract. And I'm working with a buyer that's going under contract at 34 million. So it's a 25% plus reduction. I'm seeing another property in DFW that's in North Dallas that was under contract at 43, 44 million. And it's going under contract at, I think, 35.5 million, somewhere in that range. And so it just comes down to how motivated the sellers are. And then to answer your question about, will this continue the bid-ask spread? I think as we get, longer in kind of this down cycle, and, hopefully it doesn't last too long, but, I think as interest rates start increasing, and frankly, a lot of people financed their acquisitions with floating rate bridge loans in 2021. And if floating rates keep increasing and people get in situations where, maybe their cash flow is just above a 1.0 coverage, or they're not generating enough cash flow to pay their principal and interest, or they're a syndicator and they'll have to call capital or whatever, whatever it may be. I think there'll be more motivated sellers, and there's just more motivated sellers. You'll start to see that bid-ask spread come down. You'll start to see cap rates really start to increase.
Yeah. When you look out to the future, projecting is always kind of a fool's errand. But is it really as simple as saying cap rates, interest rates are generally going to rise until the Fed starts cutting in response to a recession that they've probably caused? Or is there other factors that you're watching?
I think there's always a relationship between cap rates and interest rates. There's not a perfect correlation there, but I think there'll be some increase in cap rates. I think there just has to be, if interest rates continue to increase and if they do stay high, and then, once the Fed does cut, they'll get to a point where interest rates are, very low and cap rates are still high. And, you can finance acquisitions with Fannie Mae loans at 80% LTC again. But I also think, there's some other variables in multifamily that I think are going to make, I think a lot of the other property types, like office properties, especially, hotels, retail properties has already gone through kind of its secular decline. I think, retail has been recovering, but there's so much more capital allocation towards multifamily. And there's so many positive, factors for multifamily that I think we'll continue to see lower cap rates for multifamily in comparison to other property types. But I do think we will see some increase in cap rates, especially if the 10-year treasury stays at 3.5%. I see cap rates increasing.
You mentioned several properties that have fallen out of contract. We've seen that as well. But we've also seen some fall out because the lender decided to change the terms at the last second. How can you minimize that risk if you're on the purchaser's end, where you're trying to get to the finish line with a lender. You do want to seal your vows without the terms changing drastically. What strategies are you seeing folks employ these days to try to minimize that?
So again, another reason why it's nice to buy in 2022 versus 2021, and why I would advocate people, think about buying currently, is that it's a buyer's market. And when it's a buyer's market, you might have some more flexibility on the purchase and sale agreement and the terms of that sale. So, in 2021, you had to put up a significant amount of non-refundable earnest money day one. And in some markets, and I'm even seeing around DFW, a lot of borrowers aren't having to put up earnest money until 2 weeks in or 30 days into their contract. And so what I would say is, like, number one, if you can start looking into your financing and understanding what the financing landscape is before you even go under contract, and then even better if you have some more runway, before your earnest money goes hard, it is critically important to understand your financing and understand the outlook for financing very, very early in the process. I mean, ideally, you're talking to your lenders or your mortgage broker before you submit your best and final offer, and reviewing the pro forma and business plan with them, and just understanding like what the terms are out there. And then as soon as you have an accepted LOI, you or your mortgage broker are going out and actually getting loan applications from lenders. And hopefully you have multiple options. And then, you're as far as long as possible in the first 2 weeks, first 3 weeks, or whatever it is before your money goes hard. And that way you could avoid that situation where if there's a retrade or the lender does fall out, because it is happening, you're at least prepared to avoid it. Where people get into trouble is if they put the loan on the back burner and they don't spend any time on the loan. And then 2 weeks after their PSA, they start shopping the financing. And then, they come to realize, oh, our pro forma, these rents aren't supported by the market or whatever. And they end up, finding one outlier lender who says they'll do the loan and nobody else will. And all of a sudden that outlier lender is like, oh, actually, we can't do this loan. Or we're at 65% instead of 80% LTV or, whatever it may be. So I'd say that's one thing. I mean, I think, I'll just give an interesting story about like on a loan where we got, quote unquote, retraded. But I actually prepped the borrower and said, retraded. I'm telling you right now. So I had a loan where it was a 2-property portfolio in DFW. We were doing it was a $25 or $26 million loan. And we put our package together. We showed it to probably 25 different lenders. And most of the lenders came back at, kind of 70% LTV, low 70s. And we had one that came back at 75% LTV. And I went to the bar and I said, okay, we have this group at 75% LTV. Their interest rate, seems competitive, and it seems like a market rate. It's not like an outlier, really. And they said, well, we really wanted 80%. So I said, okay, well, you can go back and see if we can get 80%. So I went to the lender and I said, can we get 80%? They said, well, I think we could stretch to just below 80%. And so I said, okay, let's just get a loan out here at just below 80%. And so I took a loan application and gone and called the borrower and I said, the loan amount says 80%, close to 80%, but I'm telling you, be ready to close at 75% because this is the debt yield stip. This is the DSCR stip. Here's all the different areas where, they could potentially get us because I'm looking at our underwriting. I'm looking at their steps and I don't see us meeting these steps. And so just be ready to close at 75%. But sure enough, we get, 2 weeks out from closing, letter comes back. They didn't cut our proceeds. Well, they offered us 3 different options. They could maintain proceeds where they were, but increase our spread from 400 over SOFR to 435 over SOFR. That was option 1. Option 2, something in between, a slight reduction in proceeds, but a slight increase in spread. And then option 3 was 75% at 400 over SOFR. And so we kind of knew going in that there's risk here that this could get retraded, and just, having enough repetitions and enough going through this multiple times with lenders, I can kind of prep the borrower for it and ended up working out okay. So I think, to me, a retrade or a bad retrade is just when you're completely blindsided and, you just don't even see it coming. And I think, not to plug myself here, but I think working with a good broker, especially in today's market where things are very volatile and things are changing constantly. I'm getting over a call. Working with someone that does, 30, 40 of these loans per year can be very helpful.
John, I appreciate you sharing that story. It's always interesting to hear those personal anecdotes and what goes right or what goes wrong and how to prepare for that. I was looking the other day at some loan maturity dates, just like across the multifamily industry. And you're right, there's a big wall of loans maturing in 2023, 2024, a lot of bridge debt that's coming due at that point in time, at least the initial 3-year term. Over the last 10, 12 years, I think people were really aggressive with bridge debt. And they got bailed out by a rising tide in many different ways, compressed cap rates, increased rents. We're still seeing increase in rents, although I think that's going to slow down somewhat, but cap rates are increasing. We went through some price reductions that we're seeing anecdotally in various markets. Do you think that the market will bail out folks who, let's say they're maturing in the back half of 23 into 2024, or do you think there might be some real pain that could lead to a little bit of a domino effect?
Yeah, I think, now more than ever, operations are really important. And I think the better operators will do just fine. And the people that can execute their business plan and the borrowers that are well capitalized, they can kind of get through, some of these issues with increasing rates, I think will do just fine. But I do think this will be a period where people who are, not as strong in operations or the markets that aren't as attractive markets for multifamily, I think will end up having issues. And will it be 2008? Will it be, total blood in the streets? I don't think it will be, but I do think there will be, some properties that have issues. There will be some borrowers that end up losing money. And I think there will be some distress over the next few years.
Interesting to think of all the distressed capital funds that were raised right around COVID. And very little of that capital ended up being placed. Maybe they were just 30 to 40 months early.
Yeah. We're not seeing, I haven't heard really of any distress or any properties are having issues quite yet. But as I mentioned earlier, I think, as we get longer into the down cycle, as I think we get further into 2023, and if rates stay where they are, I think we'll see some issues. But, to your point, there have been so many funds that have been raised to kind of capitalize on these opportunities. And there's a lot of people who are waiting on the sidelines to pounce. I don't know if there'll be a very big window to jump in. And I think a lot of people, for sure still want to get into multifamily. The fundamentals are still really strong. So we'll see how it plays out. I think, like I said, I don't see it being a very large downturn, but I think it's, to your point, a lot of people got bailed out by the market rising, the market improving. I think people also got bailed out by the fact that they had a fixed rate agency loan. Like a lot of properties from 2015 to 2018 were financed with Fannie Mae or Freddie Mac fixed rate loans. And the operators that were having issues, the properties were performing, well, they had a fixed rate loan with a 10-year term. So they had 10 years to figure it out. Whereas everyone that bought in 2021, they bought with bridge loans. And with bridge loans, you have 2 to 3 years to get your operations and execute your business plan. And, if you haven't executed by end of year 2 or end of year 3, you're in a situation where your loan's maturing and the property is worth, less than the loan amount potentially, and you're underwater. So I think that's going to play a big factor, for sure.
Awesome. Well, if folks want to reach out to you, learn more about what you do at McKinney Capital Realty, can you share where folks can reach out?
Sure. Our website is McKinney RC. So it's McKinneyRC.com. And you'll find my contact information and also my colleague, Henry Holt. His contact information is on there as well.
Fantastic. Well, John, really appreciate you joining us today on the show. Thanks for sharing your insights. And thank you to our audience for joining us. This is your host, Sam Rust, signing off.
Thank you for being with us again today. I hope you have liked and subscribed to the show. Please tell your friends about the Real Estate Syndication Show. And I hope that you are learning and growing. Don't forget to go to lifebridgecapital.com where you can start investing today.